Everyone's favorite bull, Tom Lee, weighs in on whether or not we're in an AI bubble, as he states that he currently thinks Nvidia is priced at bargain levels. Check out this epic clip from Tom Lee.
We're in a period where there is a super cycle and exponential growth opportunities within AI, but it doesn't mean every company that has an elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is Nvidia trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210 times forward earnings. So Nvidia to me is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of an Nvidia, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, parabolic. And they're related to AI. And that's where he says, whoa, 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 whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to Nvidia and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce, I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today from his report. And he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, Nvidia is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that would be what you'd expect to be the first wave of investment and spending, is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
Hans, Tom Lee says that he believes the market is likely to shake out a little, but generally speaking, company valuations are reasonable. He also states that he believes Nvidia's current valuation is a bargain. Do you agree with Tom's consensus here?
Well, let me start with the second part of your question about Nvidia's market cap, and then we'll work back to the market from there. And let me begin by just restating Tom's argument. He was basically saying that in 1998, if Cisco already had a forward PE of 60, and then it didn't top out until over 200 PE in 2000, then a 26 forward PE for Nvidia right now seems downright reasonable. And the basic premise of this argument is that even if we're in a bubble, there's still a lot more frothiness left in this bubble, and you can still make lots of money if you know when to quit. And while I'm not sure that Tom Lee actually subscribes to the idea that we are in a bubble right now, it is an argument that holds together logically for the people who are full of fear right now. But now let's turn and look at two different arguments why NVIDIA is not in a bubble right now and actually presents an attractive risk-reward trade-off at this point in time. We'll start by looking at bottoms-up factors that we heard from Jensen Huang on his podcast earlier this week with Brad Gerstner. And he basically said that right now, their supply chain is ready to meet any demand that they get. And so they are planning with their supply chain based on all of the orders that they've received from the hyperscalers. But what keeps happening is that these hyperscalers are putting out forecasts of how much capacity they think they are going to need. And then they come back when it's time to deliver that capacity and they say, hey, hold up. We actually needed like 20% more than that, or 30% more than that, or 40% more than that. And so it's these hyperscalers that are the ones who are revising up their forecast, they're revising up their orders, and that's why NVIDIA continues to surprise to the upside on the actual sales of their chips. And this has been a consistent trend that we have seen over the last several years for NVIDIA, and unless we see a massive reversal in this trend, then I do think that NVIDIA is likely to continue to surprise to the upside with earnings, which will then in turn compress multiples and drive even higher valuations. And so that's basically the bottoms-up argument for why revenue will continue to surprise to the upside and drive increasing shareholder value, even for buyers of NVIDIA stock at these all-time high prices. All right, now that we've looked at the bottoms-up factors, let's look at the top-down factors. And for this analysis, I'm going to begin with the one and only Jensen Huang. This man absolutely belongs in the Hall of Fame for greatest CEOs and founders in history, right there beside Elon Musk and Steve Jobs. And as someone who has spent the better part of the past decade studying Elon Musk inside and out, I continue to be extremely impressed by Jensen's clarity of thought, his focus, his ability to drive execution by his team, his systems thinking, and then his massive ambitions. If you go back several decades and you listen to the interviews that Jensen Huang was giving and the types of things that he was thinking about, you can see someone who is obsessed with using accelerated computing to drive an ever-expanding circle of solutions to new problems that computing had never solved before. And it was this desire to solve novel problems that CPUs weren't able to solve that actually drove NVIDIA into the graphics market in the first place. But even as the accelerated computing ecosystem that he was building with NVIDIA became extremely competent at solving graphics problems, he always had his sights set on newer and bigger problems that he could solve that would create new customers in entire new markets. This is one of the reasons that he invested so heavily in the CUDA ecosystem long before that was ever a profitable endeavor. It's because he was trying to bring in new areas of academic research to the NVIDIA ecosystem and the CUDA ecosystem so that they could begin incubating solutions to these new and bigger problems that Jensen Huang hoped to be able to solve one day. And it was this visionary focus on R&D and exploration at the frontier of what was possible with computing that actually led to the breakthroughs in AI that we saw in the early 2010s. And so the entire existence of the current field of AI owes itself in a big way to the combination of Jensen Huang's ambition, grit, and determination. And this is what makes him such a unique and formidable CEO. And while the media is quick to announce the next NVIDIA killer, whether that be AMD or Grok with a Q or Cerebras or any number of new entrants into the AI computing market, what these new competitors find is that competing head-to-head with Jensen Huang is as difficult as competing with Elon Musk. And this is actually something that even Elon Musk found out with the Dojo program competing against NVIDIA GPUs for training of Tesla's FSD system. So when you combine Jensen Huang's leadership with the tenacious culture of NVIDIA that is tough as nails and laser focused, what you see is a company that is really just firing on all cylinders and has turned into an absolute execution machine. So when you combine these top-down factors with the bottoms-up factors that we discussed earlier, I really do think that NVIDIA is in excellent position to continue to capture the lion's share of this new AI computing market, which we still haven't even begun to find the upper limit of. Now, with all of that said, I do want to acknowledge two serious threats to NVIDIA. The first of which is the possibility that we'll see some sort of algorithmic breakthrough come around the corner that allows us to do 100x or 1000x or 10,000x more AI computation with less energy and on fewer chips. If that were to happen and it dried up NVIDIA's order book, that could be something that is catastrophic to the valuation of NVIDIA and something that Jensen Huang would have a very difficult time being able to defend against, despite the fact that he is such a goat. The other serious threat besides these algorithmic breakthroughs in software is the possibility that we could be on the precipice of a new paradigm emerging within computing as a whole that could actually transform this whole field of accelerated computing that Jensen Huang has incubated in a way that pulls the rug out from them and from TSMC. But while this is possible, I definitely don't set the likelihood of something like that occurring very high. So as an investor trying to think about how I manage risk personally, what I've done is actually divide my investments into 4 different plays, 2 horizontal and 2 vertical. For my 2 horizontal investments, I have both NVIDIA and Palantir, and these are the infrastructure plays that really power putting AI to use inside businesses across a wide variety of customers and industries. And then, in addition to these 2 horizontal plays, I also have 2 vertical plays, Tesla and Lemonade, both of them applying AI in a deep way to a narrow and specific use case with a lot of economic value locked up inside of it. Obviously, Tesla is focused on AI applied to transportation and then humanoid robotics, and Lemonade is applying AI to the field of insurance. And so, of course, not financial advice. This is just my personal commentary on the way that I am deploying capital into AI investments in the public markets at this time. And speaking of markets, let's actually circle back now to Tom Lee's comments indicating that he believes that overall, valuations in public markets are reasonable, even though some individual companies may fail. And from a 10,000-foot view, these are actually comments that I largely agree with. If you look at the market structurally, all of this success that we've seen concentrated in NVIDIA and the Mag 7 creates a lot of excitement within the investing community. And they start to ask the question, okay, who's next? Like, can these companies continue to just compound and grow indefinitely? Or is this growth something that is going to broaden out into the rest of the economy? Which is where you get the question, who is the next NVIDIA? Just like in 2020, we had the question, who is the next Tesla? And so as people look to see who are the leading contenders, there is a somewhat inevitable amount of carnage that happens as some companies that looked like they might be promising stumble and fail for a variety of reasons due to either execution or the markets or even potentially fraud. And as we invest in a market in a world that is increasingly subject to the power of network effects and scale, we have to be mindful of the fact that power law distributions are very real, and it is entirely possible for companies like the Mag 7 to continue winning at unprecedented levels that exceed our wildest expectations, while many other players who lack the scale and size of the Mag 7 actually fail to follow. But that said, some of those new companies and new things actually will be successful, which is where you get something like OpenAI to begin with. And so every now and then, a unicorn truly is born among the small caps, mid caps, or even startups that does drive a tremendous amount of value in the overall market. And so this is just like watching the evolutionary process play out in real time in the market at hyper accelerated speeds, which is a beautiful, creative, and destructive process all at the same time.
So I want to rehash this quote we just had from a JP Morgan asset manager. AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT. So one of the arguments is that we're in an AI bubble, so we're not surprised to see that asset prices have risen and that they've been a leading variable in the S&P 500's growth. But to see that it accounts for 80% of earnings growth, don't you think that's pretty incredible for the early innings of AI? And because of that, does that make the current supercycle incomparable to the dot-com bubble?
The dot-com bubble. It really is the gift that just keeps on giving. I mean, after all, we did kind of get the internet, and I don't know if you've checked lately, but it's kind of amazing. But with that said, yes, a lot of investors lost their shirts. There was so much euphoria, there was so much hope, there was so much hype, and there was so little substance. And while history doesn't repeat, it does rhyme. So is the AI boom just another version of the tulip bubble? And my answer is a resounding no. How do I know? Well, one of the telltale signs is that everyone is constantly asking, are we in a bubble? And that's just not typical behavior of people who are actually in a bubble. And as you pointed out, 80% of earnings growth of S&P 500 companies since ChatGPT launched is an astounding metric that goes to show that this excitement is actually grounded in real value in real revenues. Now, is that the case for every single company in every single narrative where AI supposedly is driving massive value? Perhaps not. But there definitely is a there, and for companies in the right positions, executing well, doing the right things, the value that AI creating is 100% legitimate, and the opportunity to drive growth based on scale and the ability to solve new problems for customers that have never been solved before is immense. And when you ask the question, where is all this money that's flowing into NVIDIA's pockets coming from? The answer is primarily the Mag 7. And what are they spending? Well, it's not debt this time around like it was in the dot-com bubble. It's actually their free cash flow, which isn't even close to being exhausted yet, much less their sizable war chests. So there is quite a bit of legroom left for them to be able to continue to invest aggressively in building out this infrastructure. So we're not talking about crypto degen personalities in the early days of COVID. These are smart, responsible executives of some of the most fantastic businesses in all of history that are driving these huge investments into a new type of computing architecture that is capable of performing tasks and solving problems that would have felt magical to us only a few short years ago. And when you step back and ask yourself, why are these executives actually investing so aggressively in this area? You don't have to look any further than OpenAI's revenue growth, which according to an Altimeter Capital report that was published in 2024, has reached an astounding $10 billion only 3 years after launching ChatGPT. And that is 2 years faster than Google reached that same milestone, and 5 years faster than Meta reached it. So this level of groundbreaking revenue growth is the reason that Jensen felt comfortable actually signing this deal to invest up to $100 billion in OpenAI as they work their way towards building 10 gigawatts of total compute capacity. Now that $100 billion is only a small fraction of the overall investment that they'll need to make in order to build out that 10 gigawatts, which leaves them on the hook to secure funding from either other sources of debt or cash flows from their business. And based on the commentary that he made in the BG2 podcast the other day, I think it is the prospect of those cash flow that they would be generating from this revenue growth that Jensen is actually excited about. So now that we've actually looked at why there is so much substance in the AI boom right now at the beginning of this major supercycle, let's also go back and think about why exactly the dot-com boom in the late 1990s actually did turn into a bubble. And if we set aside the euphoria and the speculation that was happening in the stock market around these companies, and instead look at the technological maturity of the internet at that point in time, I think those reasons start to become obvious. The harsh reality is that the internet was still very primitive in 1998, 1999, and even 2000. And this immaturity wasn't just limited to the amount of fiber that had been laid or the amount of networking equipment that had been installed. Every part of the stack that was involved in the internet, from chips to servers to clients to graphics capabilities to web software, and on, it was just very hard to conduct business or deliver content over the internet at that point in time. And let's not forget that NVIDIA is actually a key player behind the development of the computer graphics in the late 90s and early 2000s, which is really a key part of the foundation that all of the value since then has been created on, whether that is through the delivery of content or powering shopping experiences or rich immersive app interactions as well. Without high quality computer graphics, none of those things would be possible. And those computer graphics are something that were enabled and empowered by the pioneering research that was done at NVIDIA in the early days of their work on this accelerated parallel computing platform that has now actually given us AI as well. And then beyond the immaturity of the internet tech stack itself, there's also the value of the users on the internet network. Even though the internet was something that was very exciting for many people and many speculators, the fact of the matter is that it just wasn't home to enough users, enough businesses, and enough payment infrastructure to do a significant percentage of real business in the economy. And of course, in the intervening years since 2000, all of that has changed. The internet long ago reached critical mass of users, and there is an immense amount of value that is transacted on the internet every single day. Our tech stack is incredible. So rather than being the first domino to fall in the development of a nascent industry that will one day be very large, AI is actually coming into a robust ecosystem of technology, users, and value that is underlying this much faster than expected growth of AI. And this isn't even the first time that we've seen a subsequent layer of build out on the internet move extremely rapidly and never reach into bubble territory. There are many ways in which the development of the Apple iPhone in 2008 actually resembled a new infrastructure build out that extended the penetration of the internet to a vast number of new users or new user minutes with the same existing users. And yet I don't think we questioned whether the adoption of cell phones was going to lead to a second .com bubble and bust. And that was because the instant access that cell phones gave you to the already valuable network of the internet made these devices more than worthwhile, even at high price points. And this was before the App Store and the Web 2.0 boom had even begun. And then last, but certainly not least, the reason this AI boom isn't like the .com bubble is because we are learning to manufacture intelligence on demand for the first time in human history. And this is just something that is completely new. That's not what we were learning to do in the .com bubble. And this fundamental breakthrough is actually driving a phase shift in the type of tools and systems that we can create that will absolutely reverberate for decades and even centuries to come across nations, our economic systems, and even the entire world order as we know it. Before we wrap, I have to say a huge thank you to my co-host David. Besides being a great co-host with a great accent, David has been one of the key figures behind the scenes helping me to grow this channel from 1,000 to over 16,000 subscribers and to put out regular shows that reach millions of views every year. When he's not moonlighting with me, he usually works with businesses who want to leverage YouTube to grow their online presence, and he's looking to take on more. If you want to get more clients and more brand awareness for your business using YouTube, I definitely recommend him. You can book a free call with him using the link in the description below.